The U.S. economy is not in recession, but it is no longer giving investors a clean story. Growth is still positive. Employers are still hiring. Consumers are still spending. Artificial intelligence investment is still feeding pockets of optimism. And yet, beneath that surface, the economy has become harder to read and easier to worry about. Inflation has heated back up, led by energy. Confidence has cracked, especially among CEOs. Households are stretched. The labor market is resilient, but less dynamic. Trade policy is in flux, and the Federal Reserve, now under Chair Kevin Warsh, is staring at the classic central bank dilemma. Inflation is too hot to ignore, but growth may be too soft to squeeze much harder. So today, we're looking at an economy that is still expanding, but expanding under stress. As of June 4th, 2026, the key question is not simply, are we in a recession? The better question is, how many shock absorbers does this economy still have left? Let's start with growth. The latest read on first quarter real GDP showed the U.S. economy growing at a 1.6% annualized pace. That was a downgrade from the initial 2.0% estimate. Now, 1.6% growth is not contraction. It is not a recession signal by itself. It is also better than the 0.5% pace recorded in the fourth quarter of 2025. But the details matter. The downward revision reflected weaker investment and softer consumer spending. And that is important because the U.S. economy runs more than anything else on the American consumer. Household spending makes up roughly 2/3 to 70% of U.S. GDP. When families pull back because gasoline, groceries, rent, insurance, or credit card bills are taking a bigger bite, that weakness can move quickly from kitchen table stress to national economic slowdown. Then came the inflation data. In April, the Consumer Price Index rose 0.6% from March and 3.8% from a year earlier. That is uncomfortable. But the composition is even more important. Energy prices were the headline driver. Energy rose sharply in the month. Gasoline prices jumped, and over the past year, gasoline was up more than 28%. This is the kind of inflation that is politically painful and economically awkward. It is visible every time someone fills up a tank. It flows into shipping costs, airline tickets, food distribution, logistics, and business margins. And unlike a demand boom, it does not necessarily mean households are doing well. In fact, it often means the opposite. People are paying more for necessities and have less left over for everything else. Core inflation, which strips out food and energy, was lower than headline inflation, but it still moved higher. That matters for the Federal Reserve, because policymakers cannot simply say, this is just gasoline. If energy costs start bleeding into services, freight, food, wages, and inflation expectations, the problem becomes stickier. Now compare that with the labor market. April payrolls increased by 115,000. The unemployment rate held at 4.3%. Job gains were concentrated in healthcare, transportation and warehousing, and retail trade. Meanwhile, the April JOLTS report showed job openings rising to 7.6 million, even as hires and separations declined. That combination tells us something subtle. Employers still need workers. Demand for labor has not disappeared. They are not firing aggressively, but they are not expanding aggressively either. Workers may find that there are jobs available, but fewer attractive openings, fewer bidding wars, and less willingness by employers to take risks. So the labor market is resilient, but it is not easy. That distinction is central to the whole economy right now. On paper, the expansion is intact. In lived experience, it feels more fragile. The confidence data show the same split. The Conference Board's measure of CEO confidence fell from 59 in the first quarter to 47 in the second quarter. A reading below 50 means negative responses outnumber positive ones. Only 15% of CEOs said the economy was better than 6 months earlier, down from 39% in the prior quarter. Nearly half said conditions were worse. That is not just a mood swing. Confidence drives behavior. When CEOs become cautious, they slow hiring, they delay capital spending, they protect margins, they reassess inventories, they ask whether new projects should wait. They become less willing to commit to factories, offices, software, equipment, or expansion plans when demand is uncertain and costs are rising. And when enough companies do that at the same time, confidence stops being a survey result and becomes an economic force. Consumers are more guarded too. Polling has shown deep concern that the economy is on the wrong track. And the political challenge for the White House is straightforward. Official claims that Americans are thriving are colliding with the experience of higher fuel prices, higher food costs, higher borrowing costs, and shrinking financial cushions. This is where the energy shock becomes the main character. The Strait of Hormuz is one of the most important oil transit choke points in the world. In recent years, roughly 1/5 of global petroleum liquids consumption and more than 1/4 of seaborne oil trade have moved through that corridor. When conflict with Iran threatens that route, the effect is not limited to crude oil futures on a trading screen. It affects shipping insurance. It affects diesel. It affects jet fuel. It affects petrochemical feedstocks. It affects fertilizer. It affects container logistics. It affects the cost of moving goods across oceans and across the country. For households, the transmission mechanism is immediate. Gasoline prices rise, commuting becomes more expensive, and real purchasing power falls. For businesses, the shock shows up in input costs, freight bills, and margin pressure. For the Federal Reserve, it creates the most uncomfortable policy mix: higher inflation and weaker real demand at the same time. That is the textbook central bank nightmare. If the Fed raises rates or keeps policy tight to fight inflation, it risks choking off already slowing growth. If it cuts rates to support growth, it risks allowing inflation expectations to drift higher. If it does nothing, it may be accused of being behind the curve in both directions. That is the challenge Kevin Warsh inherited when he took office as Fed chair on May 22, 2026. Warsh's early tenure will be watched for more than rate decisions. Investors will be listening for his framework. Does he emphasize inflation credibility? Does he lean toward growth support? Does he signal a reform agenda inside the Fed? Does he push back against political pressure? In markets, tone can move expectations before policy moves rates. Now, energy is not the only source of uncertainty. Trade policy is another. On February 20, 2026, the Supreme Court struck down broad tariffs imposed under the International Emergency Economic Powers Act. In isolation, that ruling was disinflationary. Lower tariff pressure can reduce costs for imported goods and business inputs, but the energy shock pulled in the opposite direction. So companies are facing tariff relief in some places, but higher fuel and logistics costs in others. That makes the inflation picture muddier. It also complicates investment planning. Businesses can adapt to rules, even tough rules, if they believe those rules are stable. What is harder to manage is uncertainty about what comes next. The administration says it wants trade policy to narrow the trade deficit, raise manufacturing's share of GDP, and lift U.S. worker wages. Those are ambitious goals. But reshoring is not automatic. The U.S. still faces high production costs, labor shortages, retaliation risk, and the need for long-term policy clarity before companies commit major capital. Meanwhile, households are losing room to maneuver. Many families entered 2026 with less of a buffer than headline growth numbers implied. Pandemic-era savings have faded for many. Emergency funds are thinner. Credit card balances and borrowing costs have become more burdensome. Some households have tapped retirement accounts or leaned more heavily on credit to cover basics. The squeeze is most acute for low and moderate income families, but it is increasingly reaching middle-income households too. That is important for investors, because consumer stress does not always show up all at once. It can begin with trading down from premium to discount brands, then delaying big-ticket purchases, then relying more on credit, then rising delinquencies, then weaker revenue for consumer-facing companies. A slowdown often starts as a margin story before it becomes an employment story. And the affordability crisis is not evenly distributed. Black and Latino households are often more exposed to downturns and cost spikes because of differences in wealth buffers, income volatility, housing costs, and labor market vulnerability. That makes affordability not only an economic issue, but a political one heading into the 2026 midterms. Then there is immigration and labor supply. Some sectors still report shortages, including restaurants, agriculture, construction, healthcare, and logistics. The National Restaurant Association's support for the Dignity Act reflects the industry's view that immigration reform is connected directly to hiring, expansion, and affordability. At the same time, the administration has defended intensified immigration enforcement as necessary for border security and for protecting U.S.-born workers. Critics argue that large-scale enforcement can reduce employment by shrinking the labor force and disrupting local economies. For the macroeconomy, the key point is this: labor supply matters. If businesses cannot hire enough workers, costs rise and output is constrained. If labor markets weaken too much, household income suffers. The economy needs balance, and right now, balance is hard to find. Artificial intelligence adds another layer. AI investment is one of the clearest growth engines in the economy. Data centers, software, chips, power infrastructure, and related construction are supporting spending and market optimism. Rising asset prices tied to the AI boom may also be helping wealthier households keep spending. But the benefits are uneven. If AI allows companies to produce more with fewer workers, profits and productivity may rise, while job security weakens for some employees. That creates a paradox: an economy that looks richer on paper, but feels more precarious to workers. This matters for monetary policy too. If wealthy households and AI-linked firms remain strong, demand may stay firm in some areas. But if wage growth and job mobility weaken for everyone else, stress builds beneath the surface. The Fed could be looking at an economy with persistent pockets of strength and growing pockets of strain at the same time. Geography tells a similar story. National averages hide regional divergence. States with strong research universities, technology ecosystems, high-skill labor pools, and innovation capacity are better positioned. Massachusetts, Washington, Utah, California, and Delaware have been cited among the strongest state economies. Large states like California, Texas, New York, and Florida remain enormous economic engines in their own right. But other regions are more exposed to manufacturing weakness, agricultural stress, trade uncertainty, fuel costs, and labor constraints. In parts of the Midwest, business surveys show growth that is still positive, but less secure, with employment indicators weakening. Rural areas are also being reshaped by logistics. Warehouses, freight corridors, distribution hubs, and e-commerce infrastructure are changing the economic map. That brings us to resilience. The energy shock is one example of a broader problem. The U.S. economy depends on global flows that are efficient but vulnerable. Oil routes, semiconductor supply chains, critical minerals, shipping lanes, defense inputs, industrial parts. A disruption around Taiwan, for example, would not be only a military or diplomatic crisis. It would be a macroeconomic event. Semiconductors, fuel, munitions, repair parts, and commercial shipping could all be affected. That is why stockpiles, diversified suppliers, allied production, alternative routes, and resilient logistics are not just defense issues, they are economic insurance. There are also short-term bright spots. The 2026 FIFA World Cup should bring a visible boost to host cities through tourism, hotels, restaurants, retail, advertising, transit, and temporary jobs. Dallas and Arlington, among others, could see concentrated benefits. But nationally, the World Cup is not a cure for slower growth or higher inflation. The U.S. economy is simply too large. Local gains may be meaningful, but hosting costs, security expenses, transport upgrades, subsidies, displacement, and crowding out can offset some of the benefit. So where does this leave investors? First, this is not a recession call. The economy is still growing. The labor market is still adding jobs. Services remain durable. AI investment is real, still has deep capital markets, world-class firms, strong universities, innovative capacity, and a flexible private sector. Second, this is clearly a warning signal. Several shock absorbers are weakening at once: household savings, pricing stability, CEO confidence, trade policy predictability, and energy security. Third, the next few months matter a lot. Watch energy prices and access through the Strait of Hormuz. That is the single most important near-term variable for inflation and recession risk. The question is whether energy inflation stays contained or spreads into food, services, transportation, and core goods. Watch consumer spending. If real spending slips below a comfortable pace, it would suggest households are no longer offsetting price shocks with savings and credit. Watch hiring versus openings. Job openings are helpful, but if actual hires remain weak and quits stay low, the labor market may be less strong than it appears. Watch Fed communication. Chair Warsh's early signals will shape expectations for cuts, holds, or even renewed hikes. Watch trade policy. After the Supreme Court's tariff ruling, businesses need clarity before they make long-term supply chain decisions. And watch AI. The productivity upside may be significant, but the distribution of those gains will determine whether growth feels broad-based or lopsided. The most likely near-term scenario is a slower growth, higher volatility economy. Inflation remains uncomfortable, but not runaway. Hiring cools, but does not collapse. Consumers keep spending, but more selectively. The Fed stays cautious, trying to preserve credibility without over-tightening into weakness. The downside scenario is more serious. If the Hormuz disruption persists, oil prices stay elevated, inflation expectations rise, and households pull back sharply, recession risk would climb. In that world, Corporate caution becomes layoffs, consumer restraint becomes weaker revenue, and the Fed is forced to choose between price stability and growth support under pressure. The upside scenario is still possible. Energy flows stabilize, inflation cools, tariff relief helps goods prices, AI investment continues, wage growth holds up, the Fed earns room to ease gradually. In that world, the US muddles through with modest growth and avoids a downturn. For now, the honest answer is that the expansion has not broken, but it has become more fragile. The US economy is still large, adaptive, innovative, and service-driven. Those are real strengths. But short-term risks are interacting in ways investors should not ignore. Slower GDP growth, hotter inflation, fallen CEO confidence, strained households, trade uncertainty, geopolitical energy risk, a cautious labor market, and a new Fed chair facing a difficult first test. None of those alone guarantees a recession. Together, they tell us the economy is moving through a much narrower lane. The closing takeaway is this: the US economy is still expanding, but it is expanding under stress. For investors, policymakers, and households, the next phase depends on whether energy stabilizes, inflation cools, employers keep hiring, consumers keep spending, and Washington avoids adding uncertainty to an already complicated moment. This is not financial advice, investment advice, tax advice, or a recommendation to buy, sell, or hold any asset. It is a news analysis view of the U.S. economy as of June 4, 2026. And right now, the signal is clear. The expansion is alive, but the margin for error is shrinking.